In today's session, we will talk about corporate governance. Talking about the table of contents, firstly, we will discuss about the concept, then roles and responsibility of audit committee, audit based practices, internal and external audits, national and international practices, IFRS and FRS, provision in Company Act, BAFIA and other relevant act. So, talking about the corporate governance means rules, regulations, policies, practices under which business organizations are controlled, directed, and administered. It is the set of relationship between a company's management, its board, and its shareholders and other stakeholders. It helps to minimize wastage, corruption, risk, and mismanagement. So, the talking about the four pillars, major pillars of corporate governance: accountability, transparency, responsibility, and fairness. Accountability means being answerable, whereas transparency means open communication between and among all the staffs of the organization. Responsibility means duties, roles, and obligation to complete the task. Fairness means equal treatment between all employees of the organization. So, talking about the audit committee is a group of people, association to review, check the organizational performance. Audit committee can define as a subcommittee in the governing body that will make arrangement for internal audit and facilitate the completion of external audit. Audit committee generally focus on financial reporting, internal control system, risk management system, and internal and external audit functions. So the major roles and responsibilities of audit committees are corporate governance, legal framework, accountability, information and transparency, management improvements, internal audit performance, internal audit functions, which includes planning, execution, reporting, and monitoring. The best talking about the best practices of audit. It is independence, transparency, competence, regular review, and continuous education. It maintains the independence from management to ensure unbiased oversight. It promotes open communication between auditors, management, and the board. It ensures that committee members have the necessary financial expertise. It conducts periodic review of financial reports and audit processes. It keeps committee members informed about new standards, regulation, and best practices. Internal and external audits. Internal audits means group of people organized within an organization to check and review the organization's internal operation, whereas external audit means group of people coming from the external sectors to check and judge and um, provide the solution for the improvement of the organizations. So internal audit is an independent, objective assurance and consulting activity designed to add value and improve organizations' operations, which helps to identify risk and find better way and best practices. Focus on risk of occurrences, likewise fraud, improper reporting, inefficient use of resources, etc. Whereas external audit involves the examination of companies' financial statements and record by an independent external auditor. It usually required by law or regulation and provide assurance to shareholders and stakeholders. So moving on, benefits of auditing in corporate governance. It will help in enhancing financial reporting, detecting frauds and errors through rigorous examination and testing, helping prevent financial losses and reputational damage, assessing internal controls, improving decision making, etc. International and national and international practices. National practices: adaptation of NFRS compliance with local laws such as the Company Act and Mafia adaptation to suit the local economic environment, whereas international practices arrange to IFRS for global consistent benchmarking against international audit standards and incorporating best practices from leading economies. IFRS globally accepted accounting standards focusing on principle based financial reporting. NFRS Nepal's adaptation of IFRS tailored to fit the specific need and regulatory environment of Nepal. Talking about its impact, it helps in maintaining transparency in financial reporting. Provision in Company Act, which is mentioned in Section 164 Audit Committee, a listed capital with paid-up capital of 30 million rupees or more, a company which is fully or partially owned by the government of Nepal, shall form an audit committee under the chairpersonship of director who is not involved in the day-to-day operations of the company and consisting of at least 3 members. A person who is close relative of the executive of a company shall not be eligible to be a member of the audit committee found pursuant to section subsection 1. Audit committee shall meet as necessary. The chairperson of audit committee shall be present in the annual general meeting of company and so on. These are the BAFIA and other relevant act related to corporate governance. NRV Directive 6 Code of Conduct for Directors. Directors should not interfere in day-to-day operation of the financial institution. If there is a conflict, directors need to inform the board before assuming office. Directors should not involve in activities which is against the interest of company. Chief executive should work full-time. Directors of the deposit taking institution cannot act as directors of the other financial institution. Director cannot act as custodian or trustee of any of the customer. Directors shall not misuse their position and should deal fairly, and so on. Talking so moving on conclusion, corporate governance is not just regulatory requirement, it's a strategic advantage. It shapes the company's culture, reputation and long-term success. And key takeaways includes transparency and accountability are not are non-negotiable. Ethical behavior drives stakeholders trust. Board diversity foster innovation, and we can recommend following: regular board evaluation, robust risk management, engage with stakeholders. Thank you.